All right, welcome back to the show. Joining us here in 1 second, let's see, there you are, is Tucker Maxwell. And Tucker is a senior loan officer with Guild Mortgage. That's a mortgage banker, correct, Tucker? Mortgage
Correct. Yep.
banker. To add a little something, what did I get right? Any comments on my opening Real Talk segment?
No, I think you nailed it. I think the important thing to mention is that the Fed did raise the rate today, but home loan rates did drop.
Yeah, that's always the big confusion. People, oh, they raised the rate, so my rates will drop or will rise, and that's it. And we've talked before on the show, so I won't rehash it. But go back and watch one of our past podcasts to see it really is about the intention of fighting inflation. So let's talk about down payments today. So there's a lot of misunderstanding about what is needed for down payment for a home. I remember way back in the day when I bought my first home, I thought it was pretty like, where was I going to come up with all this money? Only to find out I didn't need as much as I thought I did, and it was hard. I had to save up for it, but it was well worth it. So, as you're consulting the public here today, what is the minimum down payment to buy a home in Washington?
Yeah, so it depends on the loan type that the borrower is looking at utilizing. So there's multiple options or multiple answers to this question, but on a conventional mortgage today, you can get in with as little as 3% down, and on an FHA loan, 3.5% down. But the other really cool thing in Washington is we have great down payment assistance programs that cover the full need for a down payment. And so a buyer today could get into a home with just covering a portion of the closing costs and no portion of their down payment.
Wow. So that's obviously for people that qualify, right?
Correct. Yep.
Yeah.
Pretty generous qualifications, though.
And I also don't want to forget to mention that a VA qualified borrower puts zero down. So
Yep.
if you are a veteran, you have a certification to utilize that program, and essentially you're just paying some closing costs, right, as a veteran.
Exactly. Yep.
Yeah. So served in the military, currently serving in the military.
Yep.
Um,
Honorably discharged or actively serving, and their family.
and their so tell me more about that. We should actually do a segment more on VA loans, but so they can actually help their family qualify.
Yeah. So think of like a surviving spouse. Yeah, they get the same benefits.
Okay, cool. All right, so we're talking. So it sounds like there's some options for down payment, but why should somebody buy now versus waiting until they have 20%?
Yeah, so I think the common myth is that we should avoid mortgage insurance, right? Like if you can't put 20% down, there's going to be this big, scary mortgage insurance premium that's included in your payment. And if you can't put 20% down, you shouldn't do it. And in reality, that's a moving target. You know, you talked about this in your Real Talk segment about the price of homes. And if we have somebody that's looking to save 20% and determining how long it may take for them to get there, home prices are going to continue to escalate, right? Average appreciation, 3 to 5, maybe 6% every year. That 20% number that they're aiming for is going to continue to grow. So if it's a moving target, will they ever get there? And then to answer the question about mortgage insurance is, it's really not as scary as it once was. And if we can secure a lower price today with less out of pocket, paying mortgage insurance may be less than waiting and buying at a future market.
Yeah, see, it's interesting because our market here in the Pacific Northwest, or at least in the greater Puget Sound area, is a lot about appreciation and not as much about cash flow. And I say that as a investment strategy, but I have helped a lot of people that made really pretty good money, and specifically your example of the down payment assistance, they made in that threshold. Do you remember what the income qualifications you have to have? It's above a certain amount, but below another certain amount.
Yeah, it's below $180,000 right now.
What?
Yeah.
That's crazy.
Yeah.
That's actually great. So if you make less than $180,000, you can qualify for, what is it, a $40,000 bond?
It's up to 4% of the purchase price.
Up to 4% of the purchase price. We
Yeah.
got to see some numbers on that. That's actually pretty great. So essentially, whatever it is, it's up to 4% of the purchase price. So whatever you would qualify in that rate, We have to see some math on that maybe sometime, maybe next week. Bring us the math on that.
Yeah, absolutely. Yeah, the cool thing about it is too, with those programs, they only require a 3 or 3.5% down payment, depending on if you go conventional or FHA. So there's even some money left over to cover a portion of the closing costs. Now, if
And
they work with you and you
yeah,
negotiate in some seller paid closing costs, you could literally get into a home with maybe the first payment out of
right,
pocket.
right. That's actually pretty cool because the market's a little softer. We may be able to, and actually we just did last week. We negotiated $10,000 in closing costs on a purchase. So even though, as I said, it's a hot market, if a home's on the market for a couple of weeks, you can get some closing costs paid for. So, well, at least excellent negotiators like myself can help you.
Exactly.
Yeah.
You can always
Okay, so
add it in too, right? Increase the price by 10,000 and ask for 10,000 back. Proceed remains the same for the seller. So there's ways by working with you that you can work it in, even in some, perceived hotter home or, one with multiple offers.
Yeah, and if people are out there thinking, well, I should wait now versus buying later, what is the cost associated with that?
Yeah, so one, you're foregoing the appreciation that you're going to get by buying today versus however long it takes you to wait. So 4%. So if you wait, you're foregoing that appreciation. You're also paying rent. So let's just assume, let's say $3,000 a month. That's $36,000 right there if you wait a year. You're also not going to get the tax incentives by buying a home. So you're going to lessen your tax burden by paying interest and, writing off some of the expenses of home ownership. So there's a lot of advantages that add up to significant savings by buying a home now versus waiting into the future. And I'll send you after this, Dan, a calculator that you can share with people that allows them to do that math and say, okay, what am I waiting for? Am I waiting for a certain rate? Okay, what rate am I waiting for? And how long do I expect it to take to get there, which who knows? And it calculates that out based on how much they pay in rent. And what's the average rent in Seattle right now?
Oh, I'm over 2,500 for anything decent.
Exactly.
Yeah. So. Wow. Okay. So the last thing we did talk about earlier was private mortgage insurance. First off, explain what it is, and then tell me why we should or shouldn't try to avoid it.
Yep. So mortgage insurance, and it's mortgage insurance on FHA loans, private mortgage insurance on conventional mortgage. It allows us as the lender to pass some of the default risk to an insurance provider. So we're saying, hey, Fannie Mae is only going to take on so much risk, and this insurance company is going to cover a portion of the default risk as well. So it helps when somebody puts less than 20% down, us to offer them home loans without just having enormous risk of default. And so you carry mortgage insurance until you have 20% equity in the property. So if you put 3% down or 5% down, 10% down, you're going to have mortgage insurance. And then as you make payments and you get to that 20% threshold, it would fall off. The really cool thing about mortgage insurance is it's now risk-based. And so we're going to look at the borrower's qualifications, credit score. Is there one borrower versus two? What is their overall debt to income ratio? And the mortgage insurance speaks specifically to the risk that they present for default, not just this overarching cost for everybody. And so if they're a good credit score, there's two borrowers. So if one loses their job, the other one still can cover the mortgage, things like that. That mortgage insurance premium is much less. And so we're talking, less than $100 in some situations for mortgage insurance.
Wow, that's cool. That's based. So it's a combination of the fact that you're not 20% leveraged or whatever it is, 80% leveraged, and the qualifications of the individual. So exactly. It can be less if you're a better, less of a credit risk. That's awesome.
Yep. Pretty cool.
Well, cool. So we learned a lot of great things today, Tucker. Thanks for bringing some great information. As you guys know, you can always reach Tucker at his phone number, 425-757-9202. You can reach out to the Eastside Real Estate team and we'll get you connected. I got to say, if you're out there making $150,000 and you are renting, we should talk because we can get you into something and maybe you haven't saved up a dime and we've got options. So we'd love to be able to help you through that. Tucker, thanks so much for coming on. Appreciate it.
Absolutely. Thanks, Dan.
All right. We're going to have another short commercial break and we'll be welcoming back Alicia Howard of College Insights. Don't miss this segment. We're going to be discussing the strains of college loans and what new policies mean for you.